All right, in today's video, I'm going to take a look at several markets um, in relation to their moving averages, their long-term moving averages. Um, these are weekly charts. This is the 200-week moving average. Um, you can see the Nasdaq here has just gotten stretched insanely far above its long-term moving average, and we've moved down into what I think is likely to turn out to be an intermediate cycle low, but it was very shallow. And I noted in one of my previous videos that at this point, I think I have become convinced that we are starting the bubble phase in the stock market. And it looks like we're starting it much earlier than I was anticipating. You can see the big change in character here. The market was holding reasonably um, close to the long-term moving average. Got a bit stretched here as the um, Fed started QE when the repo crisis began, and we had the crash in the four-year cycle low. And then coming out of this four-year cycle low, just this insane rally driven by trillions of dollars of QE. And then we get our intermediate cycle decline, but it's very mild. Didn't drop very deep, and it looks now like that intermediate correction it appears to be completed. You can see we've got a weekly swing and some nice follow through. This would turn out to be week one. And then this poses an interesting question. If this is um, a bubble forming, and it started back here in March, they usually last about a year to a year and a half. So you would kind of estimate that it's going to top maybe in the summer of next year. And then that brings up the possibility that this four-year cycle is going to left translate. So if this does indeed turn out to be a bubble, and we top next summer somewhere in here, and then start a longer-term secular bear market, um, then we're looking at potentially this four-year cycle left translating and topping the middle of next year. But normally when I step back and look at a long-term chart like this and see something that's stretched this far above its long-term moving average, I would assume that we're in store for a violent move back to tag the average, kind of what we did right here. But in this case, the one time that it doesn't really happen is when an asset is in a bubble, and then it just kind of keeps going and going. And that's kind of what it looks like is happening here is that we are, in the middle stages of a bubble. Character of the market has changed, and we should still have 6 to 8 months to go, I guess, before this would potentially um, pop. And moving on to the dollar, this is part of what is driving the bubble that is forming in stocks, and I think we'll have one in gold after that will top after the stock market. But I think it's the driver is in the currency markets. Central banks have just gone on an insane money printing spree all over the world. Right now, we're in what I think is a counter trend rally. You can see the dollar got stretched pretty far below the 200-week moving average, and we're getting a little bounce. We still haven't broken this intermediate trend line yet, so I'm not convinced that the bounce is done just yet, even though we've pulled back from that trend line. That's not unusual. That's a strong resistance zone, and it's not unusual to pull back on the first tag and then have to try and make a second run at it. You convert this to a daily chart and you can kind of see. So you can see here we've rallied up to tag it. Was not able to go through it on the first try, pulling back now, but I suspect we're going to have a second attempt that'll you know break through this, give us that final confirmation, and maybe by mid to late October, beginning of November, we come up here and tag that 200-week moving average. But I think this is a secular bear market, so I would assume that price would not be able to hold that 200-day moving average, and maybe we get kind of a final kiss goodbye, and then start the next leg down in the bear market in the dollar. But right now, I think we're recharging here, and we're going to take another run at this intermediate trend line. Maybe it happens tomorrow. We get the employment report tomorrow. Maybe that's the trigger event to um, push this dollar up again and try one more time to break through this trend line. And then finally on gold, kind of the same thing, just really, really stretched above this long-term moving average. I don't think gold is ready to start a bubble phase yet. And you can see the stochastics here have turned down. They're moving down. It's moving into an intermediate cycle low. Not convinced that it's done just yet. With price stretched this far above the moving average, I think we've either got to come down a little bit more in the next several weeks, maybe to this 1750 zone. Get the weekly stochastic fully oversold. Like almost all intermediate cycle declines do push the stochastics to oversold. March was kind of an anomaly. It only took 2 weeks to complete that drop. I doubt that this is going to bottom until the stochastics get fully oversold. But if we don't, if gold doesn't come down a little further and shrink some of this big gap here, then I think the odds are good that it's going to be stuck in a sideways churn for a long time to allow this moving average to catch up to price. So I think it would be more constructive and better for bulls anyway if this would just come down and complete this correction, maybe back into this consolidation zone right in here between whatever it is, 1670 and about 1800. I would like to see gold at least retest this support zone here at 1800 before I give the all clear to get back in. And then at that point, if stocks are in a bubble and they're going to top in possibly in the summer, I think gold would kind of follow behind that. And then as the liquidity comes out of the stock market, when that bubble pops, I think it would go into the gold market, especially if gold is continuing to go up. And then we would maybe get a final bubble top in gold as well, but later, maybe end of fall of next year, or maybe even into early 2022 might be a potential spot for a top in gold. This particular 8-year cycle is getting really mature. It's getting pretty long in the tooth here. So, but I do expect, and it already has, I expect it to right translate. So it's possible that we could get our 8-year cycle top maybe in the early 22, and that could be the top of the gold, what I would think would be a gold bubble as well. But I think we need a little bit bigger correction here before this is done. Something to we really haven't turned sentiment back down very much. We're not even back to 50% bulls, and I would really like to see that get below 50% bulls, preferably to like 40% or 30% bulls. That would be a lot of fuel that could really drive another big leg up. From this current position here, I think the last time I looked, we were at about 60% bulls. That just doesn't give you a whole lot of fuel to drive another big move and to push price, even further above this moving average. So we'd like to see this come down just a little bit more, preferably at least back down to this consolidation zone or bare minimum to test this support zone here at 1800. Push this weekly stochastics down to fully oversold, and then I think that sets the stage for another big push higher, maybe even as high as a 3,000 by this spring or summer of next year.